Okay, Assalamualaikum and salam sejahtera. So today we continue with chapter 8, that is project analysis and evaluation 2. Okay, so we are going through the break-even analysis. Okay, so what is break-even analysis? Break-even analysis is a tool of analyzing relationship between sales volume, that is Q, quantity, and profit. Okay, our concern in break-even analysis is to find Q, that is unit sales volume, and how much profit we get in the future. Okay, so we are concerned with two important costs in break-even analysis, which are variable costs and fixed costs. So let's take a look a bit information about break-even analysis and how to calculate the break-even analysis. Okay, so as I said before, it is a common tool for analyzing the relationship between sales volume, that is quantity Q, and profitability. So based on three types of break-even measure. Okay, the first one is accounting break-even, cash break-even, and financial break-even. So as I said before, we have two important costs in break-even analysis. The first one is variable cost, that is cost that change when Q output change. For fixed cost, is a cost that do not change when Q output change. So total cost is a sum of variable cost and fixed cost. Okay. So our concern in break-even analysis is to find Q, quantity or sales volume, and how much the profit we get. Okay, so basically we have three different types of break-even analysis with different formula. Okay, so for accounting break-even, sales volume at which net income equal to 0, and when net income equal to 0 based on bottom-up OCF. Okay, when net income equal to 0, OCF equal to depreciation. So based on tax shield approach, okay, QP minus P minus FC, 1 minus TC plus DTC. Okay, Q is quantity, P is price, V is variable cost, FC is fixed cost, depreciation, and tax cost. Okay, it occurs when net income equal to 0, thus OCF equal to depreciation. In terms of payback period, okay, the payback period is equal to the life of the project. Okay. For cash break-even, sales volume at which operating cash flow is equal to 0. Okay, so we have to find Q when OCF equal to 0. So QP minus P minus FC, 1 minus TC plus depreciation times DC equal to 0. So when OCF equal to 0, we have never payback period. If we don't have any payback period, and then we get a negative NPV, and IRR also shows negative 100%. For financial break-even, sales volume at which net present value equal to 0. Okay, so QP minus P minus FC, 1 minus TC plus depreciation times TC equal to OCF star. So what is OCF star? How to calculate OCF star? OCF star, that result is 0 NPV. When NPV is 0, negative IO, negative initial outlay plus sum of present value cash flow, okay, equal to 0. So sum of PVCF, how we calculate sum of PVCF? Sum of OCF times PVIFA, IN, okay. We just put the percentage for PVIFA and the number of years project equal to initial outlay, and then you get OCF star. Okay, occurs when NPV equal to 0, OCF equal to initial outlay, and internal rate of return equal to required rate of return. Therefore, discounted payback period DPP is equal to life of the project. So that is the differences between accounting break-even, cash break-even, and financial break-even. Okay, so let's take a look at tutorial for break-even analysis. Okay, so this is the first question. Okay, as we can see, we have a 10-year project, will cost 100,000 to construct. Okay, it will be depreciated on a straight line basis to zero over the 10 years life. Okay, so your initial outlay is 100,000 and equal to 10 years, 10. Okay, price per unit is 100 ringgit, so P equal to 100. Variable cost per unit is 24 ringgit, BC equal to 24, and fixed costs are 40,000 per year, so FC equal to 40,000. So the required rate of return is 10%, that is I, and the tax rate is 34%, that is TC. Calculate cash break-even point, accounting break-even point, and financial break-even point. Okay, so we'll continue with the workings for the three question. Okay, so this is the answer for the question. Okay, for cash break-even, QP minus P minus FC1 minus TC plus DCC equal to 0 when OCF equal to 0. Okay, we just put the information given. Okay, so P, so because our concern in break-even analysis is to find Q, so we just leave the Q. Okay, so you just put 100 ringgit is a price minus 24 ringgit is variable cost minus 40,000, that is FC, 1 minus 0.34 plus 10,000 times 0.34 equal to 0, because cash break-even is equal to, OCF equal to 0. So 100Q minus 24Q minus 40,000, 1 minus 0.34 plus 3,400. Okay, equal to 0. So 3,400 is DBC, 10,000 times 0.34. So how to calculate depreciation? Okay, so depreciation, you just put initial outlay for the project is 100,000, you divide it by 10 years project, you get 10,000. Okay, so and then we just settle out this bracket, okay, plus 3,400, and then you get 50.16Q equal to 23,000, and then the last answer is Q equal to 458.53 units. We round up the figure, okay, equal to 459 units. Okay, this is the Q for cash break-even. Okay, next we continue with accounting break-even, which is OCF equal to depreciation. So Q 100 minus 24 minus 40,000, 1 minus 0.34 plus 10,000 times 0.34 equal to depreciation, that is 10,000. So you just focus on the first bracket. Okay, calculate the first bracket, 76Q, okay, minus 40,000, 1 minus 0.34 plus 3,400 equal to 10,000, and then we get 50.16Q minus 26,400 plus 3,400 equal to 10,000, and then the final answer for Q is 657.89 units, which is 658 units for accounting break-even. Okay, for the last one is financial break-even, OCF equal to OCF star. Okay, so this is based on the MPV equal to 0. Okay, so we just calculate for OCF star first. MPV equal to negative initial outlay plus OCF times PVIFAIN. We just put the percentage of interest, 10%, required rate of return, and 10 years number of years project. Okay, so when MPV equal to 0, so 100,000 equal to OCF, this is the manual formula for PPIFA 10% time. Okay, we just calculate, okay, the bracket, and then we get 6.1446. Okay, then you divide it by 100,000, and then you get 16,274 ringgit 45 cent. That is OCF star. Okay, so to find Q for financial break-even, OCF equal to OCF star. So you just put the same information based on the question. So Q 100 minus 24 minus 40,000, 1 minus 0.34 plus 10,000 times 0.34 equal to 16274.45. And then finally we get 50.16Q minus 26,400 plus 3,400. Okay, we put OCF star here, 16,274 ringgit 45 cent, and then you divide it by 50.16 to find Q. Okay, the final answer is 782.98 units or 783 units. Okay, this is the answer for financial break-even. Okay, so we are done with break-even analysis. Okay, so hopefully you can understand what is the basic of break-even analysis and how to calculate Q, sales volume, for the project in the company. Okay, so we will continue with the sensitivity analysis after this, and thank you.